Well, the market's getting a little nervous about the US economy and whether the Fed might start to ease back on the amount of money printing going on. But whenever we hear that mentioned, the market gets a little fearful, and we're seeing sell-offs in asset prices. So my feel is that although the Fed would like to start to slow down the amount of money printing, it's probably going to be forced to continue the money printing for longer than perhaps it would like to do so. And the rest of the central banks around the world will follow that same pattern, I believe, and the Japanese aren't going to stop anytime soon. The Swiss will continue if the Swiss franc starts to strengthen again. The UK and the ECB, they will also follow suit if they feel their economies are going to continue to slow down. So, I would like to think that they might be able to taper it, but my gut feeling at the moment is that they won't, because the markets probably won't allow them to. Be very cautious. Enjoy the volatility. If you're a trader or you have a very good crystal ball, then you may want to continue to, at least with part of your portfolio, play the markets. But I do think with markets having risen so high, particularly equity markets and property as well, it's getting towards dangerous times. There's still a lot of debt and credit out there, and I think you need to be, if you've made nice profits, now's a good time to take some equity, some cash off the table and enjoy some of your profits, and just be a little cautious. The problems with the amount of money that's been printed out there is that a lot of assets are pretty fully priced. So personally, we don't like the look of equity markets in the short term. Longer term, we have lots of ideas that we quite like, particularly in Asia and Japan. The bond markets, I would be very frightened of being in the longer dated, the higher risk, non-investment grade, emerging market sectors. Having said that, interest rates are probably not going to rise anytime soon. So, but there is real risk there. Commodity markets demand is weakening, and whilst demand is weak, I don't think you're going to make a lot of money there. And the property markets look pretty frothy to me in most places. We've certainly seen key areas like Hong Kong and Singapore and Shanghai and London and Washington and New York. Prices have moved. The prime properties move very fast, very quickly. So again, there's not many risk assets that we like. I would keep a lot of money in fairly neutral and cautious areas at the present time. I know that sounds very defensive, but I think that's not a bad place to be. I think you need reasonably strong constitution. Yes, I think the region is very attractive, taking a 5 to 10 year view, extremely, particularly Southeast Asia. But I do feel we've seen equity markets move quite strongly, and some of the liquidity and the bubble that's come out of money printing has found its way into local economies, which has not only driven equity markets up, but also strengthened currencies. And the danger on a bit of a setback is that both the currency and the equity market falls at the same time, and that could be a bit destabilizing. So in the very short term, I'm nervous. In the medium term, we would love to increase our weighting to the region, but at much lower levels than today. So I'm being greedy, but we would like to buy much more cheaply. I would focus more regionally on Southeast Asia, so we would be looking at the larger Southeast Asia rather than Northern Asia. So I'm not so keen on China, Hong Kong, South Korea, Taiwan. We're much more interested in the Southeast Asia region. And of course the strong markets are all built around Singapore, Malaysia, Thailand, Indonesia, Philippines. And yet there's some wonderful opportunities over the next 10 years for the likes of Vietnam and Laos and Cambodia and Myanmar. So they're all going to become more interesting once they become bigger markets. But those markets have risen very, very strongly, both locally and from money pouring in from around the world. So, I think the best money's been made, in my view. But if you're a very long-term investor, pick your stocks right, pick your fund managers right, and take a long-term view, and don't worry about the short term. But it could be a bumpy ride, is my view.